This is getting annoying. This is getting annoying. Yikes. Hey, welcome to the Closing Beat, everybody. Happy Wednesday. How you doing out there? Hope you're having a good day. Welcome. All is good. Did you see our new set coming along? Let me get rid of the music there, but look at that. That desk over there, man. We got some lights on it. Getting the computer set up with everything. Looking forward to it, man. Get out of this. It's right back there. That's all it is. Back to the Closing Beat set here soon. But you guys are not here to hear about that. You want to talk about the stock market? Got some green for a change, right? That's a little bit different. So we're breaking a streak, right? Where you had the NASDAQ's down 7 days in a row. The Russell 2000 was also down 7 days in a row. The S&P, just kind of floating lower. Well, today you got a little bit of a recovery. It's not much of a shock to you, though, right? Remember yesterday I shared some data with you where we said, well, typically the Wednesday following the Labor Day holiday tends to be positive anyways. So Monday would not be here. That's Labor Day. And if you look forward to the average performance throughout the week there, you got Tuesday, normally a pretty aggressive down day. And you got Wednesday with some gains. The rest of the week, not so pretty, but basically flat all in all, if you're looking there. So basically the stock market's performing right in line with its average. Just we happen to outpace the average here today. We outpaced it yesterday, or we almost outpaced it yesterday. And so, that's fine. It's what to be expected. Remember, the market right now is going through what is known as a below average cycle, meaning it doesn't outpace itself. It's not outpacing its average. The last 10 years. Well, actually, let me show you. So if you're a client, and our notes from Jazz, it's probably in here somewhere. Let me pull it up. Yeah, this last guy here. So I'm going to bring this in so you can see it a little bit better. This is what we shared in our letter, and I talked about it and everything, but let me try to briefly explain. So we have the total annualized returns over 1, 2, 5, 10, and 20 years. And this is what's currently happening. So the green is current, depending on what time frame you're looking at. The average is the lighter gray color in the background. So for example, over the last 10 years, the average annualized return is 10.5%. So if you saw something like that in your portfolio, awesome, congratulations. But the stock market during that period was outpacing itself. It was running at a 13.1 average, which just means that it was a very strong bull market. We're just plowing ahead, and you lived through it, so you know what's going on there. Over the last 5 years, if you take any 5-year period in the stock market, the average annual returns is 10.4%. Well, over the last exact 5 years, we're running at 11.8. So again, just running above average, coming out of the end of the last bull market, as you guys know that we are now. Well, look at what happens when you come in a little bit closer. Over the last 2 years, annualized returns over any 2-year period, 10.7%. We're running at 7.9. Oh, that's a little slow down there, right? We're coming out of that, full steam ahead bull market. Over the 1 year, of course, it's a little bit worse than this, but over the last 1 year, actually, it'd be better than this as of today, but we're down 11.2%. Average annualized 1-year return, 11.9. This is going back to 1929, which is why that number is so high and does not account for inflation. These are just raw returns, including dividends. So what happened? You've got a 10-year average market that is lagging behind the current performance. In other words, stock market's moving faster. But as you get closer in time, we're starting to slow down. Right? So we're now in what's known as a below average cycle. That's all that means. Eventually that'll change course. But for the moment, as the markets pull back and perform less than their averages, you got to recognize that, because a lot of times investors, especially DIY investors, what the annualized returns are. Everybody knows you're at that 10.1, 10.7% long-time total annualized returns. And so when you know that, but you're not feeling that in a given year or over the course of 2 years, you can be a little dangerous. I've seen it, right? We have thousands of clients here, and they're always emailing, telling me what's going on. And so you get to pushing the envelope a little bit, searching for things that maybe you shouldn't be in, things that are a little more aggressive and start to pull you off of your track. The typical financial advisor would say you're coming off of your total plan, right? Your financial plan. And so that's dangerous. So when you look at the stock market here, this year, we're running behind average, and that's fine. You have to have down years in there in order to get an average, right? And so finding days like this cause you, the retail investor, to go, ooh, that's the bottom, right? I'm going to buy that sucker. I'm going all in. I'm going to do it. Well, you really need more information, right? The stock market is giving you a seasonal strong day. We know that that's the case from the data that I shared with you. And so we know that it's supposed to be strong, but we know that the rest of the week is not likely to follow through. If so, very minimal to the upside or downside. Add to that, we've got a lot coming up. The next Fed rate announcement predicting that, it's 0.75%. Midterm elections, all this great stuff. You know that September is historically weak. And so you can't just dive in and be like, that's it. Green, high or low, here we go, right? Be a little bit careful on that one there. So a little off topic to get the day started here, but just wanted to put that out there because a lot of times if I can get you to sit on your hands for a minute, that's a better value than picking a stock and it goes up 5%, right? If you can avoid some weakness, some disaster, some sideways movement, well, a lot of times that'll add to your total returns. I wish I could avoid some of those for sure. Anyways, let's go back over here. So you're looking at the S&P on your charts today. Of course, we did have a little bit of a gain there, and it was pretty broad-based with the exception of oil. Pretty nasty day for oil, down 6%. Oil inventory numbers, of course, having an issue there, and the extra 100,000 barrels per day, sort of the, here you go, Mr. Biden, we'll do a little bit extra than what you asked for, causing the price of oil to fall. And so anything energy related just had a weak day. That's just to be expected. Those are correlated quite nicely there. And, okay. So the battery was just out there. So let's go over here. You look at ExxonMobil, little pullback there, little tiny attempts at rallies throughout the day. I don't know if you were looking at energy today, but that's a decent sign that we have the big gap down in the morning because of overnight oil prices. And then you finally get maybe a little bit of a rally during the day. So not too bad there. But other than that, sector-wise, you're going to see a lot of strength. In fact, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 sectors out of 11 gained over 1%. Energy was the only sector that was down on the day, and it did lose over 1%. So a little bit of a weak start there. Now, as far as the broad markets go, it's a little bit of a weird time here. We get economic numbers that suggest the economy is not as weak as a lot of us maybe think, or as people think. Maybe we're not in a recession. We are technically in a recession, no matter what people want to change it to. It's a recession, right? So it's labeled as one. Whether people agree to admit that or not, it's another story. But here's the problem. So we got econ numbers coming out saying, well, maybe this is not such a bad recession. This is actually pretty light, soft landing, as the Fed wants to call it. So you say, okay, cool. No, it's not cool. So for the market, it's turned out to be a bad thing. Good news is bad news, and bad news is bad news. That's exactly the type of world we're living in right now, because good news means the Fed can raise rates. Bad news for growth stocks, bad news for stocks in general. Bad news is, of course, bad news. It means, oh my God, the Fed's pushing too hard here. They're going to keep doing it. They said they're not going to stop anyways. Oh, this is a really, really horrible thing here. There's now a 70% chance that the Fed's going to raise rates by 0.75% at the end of the month. I think it's in 2 weeks, actually. And so any good news that comes out just solidifies the fact that they should be doing 0.75% or maybe even more. Any bad news that comes out, we go, well, that's, it's the Fed. They're raising rates and things are just rough right now. So there's nothing to be had in terms of long-lasting good news for the moment. Keep that in mind. All right, keep that in mind before you spend a lot there. Anyways, so we talked about the S&P. Kind of funny how it's on track for doing what it's doing there based on the data that I just shared with you a minute ago. Apple kind of stole the show today. They had their Apple event. Historically, the stock is lower on iPhone announcements, which is what today proved to be, with the exception of the first iPhone. I mentioned this in the past there, but when Steve Jobs came out with that first iPhone and the world was sort of shook by this concept of a glass screen and all that stuff, the stock gained 8.3% on that day. I'll never forget that one. So aside from that, the average performance is actually negative by about 0.5%. Apple bucked that trend today with all of their phones and the watches that are supposedly going to be amazing there. And so that was kind of the headline if you're looking around stocks there to find anything interesting. The volume was there today. The activity was there. You also had Microsoft, which is a big mover, finally getting a little bit of a bounce. Alphabet as well. These are the big stocks that do the lifting in the markets. Remember? Amazon is sort of refusing to play along for the first part of the year with the market on any bounces. And now maybe there's something there. I don't know. Let's go over to Tesla real quick. Kind got to look at Tesla for the day. A little bit of a bounce there off the 50-day and has managed to hold the 50-day better than some of its other competitors in that size. Anyways, consumer defensive stocks there. You got Walmart, Coca-Cola, Costco, Target, all those looking well. I want to point out financials. There you go. So relatively weak compared to the market. Why? What's going on there, right? Money hasn't shifted over to the financials, the big financials, like it has a lot of other areas. Money was quicker to go back to tech stocks than it was to financials. I think that's a mistake that ultimately is going to catch up, if you catch my drift there. American Express and PayPal and things like that, all very interesting, but not a lot to speak of today, just broad-based rallies. If we go over to the NASDAQ here today, of course, broad rally there, all the big cap tech stocks that I just talked about. You got Dow. Higher today as well. The big mover for the Dow was Home Depot, right? Yeah, Home Depot adding $8 today, which it's a $300 stock. So it has 3 times the weighting of Nike and 3M, which gained more than the Dow or than Home Depot, but it has more of a weighting there. So heads up. I also want to point out that the Dow is the best performing index so far. Or still remains the best performing index year to date, with down only 13%. And more interestingly, over the last month, the Dow is only down 3.7%. You can't say that for the NASDAQ. Down 7%. The S&P down 4%, right? So the Dow being tiny and everything, it's holding up pretty good there. I can't complain too much you can't complain too much if you're a Dow investor. All right, sector-wise. Let's go over here. Energy. Over the last month, energy managed to gain another 7%. There's only one other sector over the last month that has been positive, and that'd be the utilities. Almost back to highs. Very strong today. Very quick recovery. That's, I would argue, stronger than energy in the very, very short term, but over the last month, it comes in second place. Over the last month, tech stocks give you the biggest discount, down almost 10%. Communication services, which is a lot of tech stocks as well, lost another 5%. Those two battling for last place for the year, by the way. Healthcare down 3%. That pullback really is yet to be bought up, but that's what it is. And real estate, I want to point that out, down about 3% so far over the last month. What I'm looking for here is, where are the biggest pullbacks? Where's the weakness? Well, it's in tech, right? XLK, or any way you want to look at it. There's your weakness. Where's your strength? I would argue utilities over energy, but energy does win. So there you go. You're looking on both sides of the market. You know what you're looking for. If you're interested in building a watch list, now you know what you're looking for. All right, stocks in the news, and then that's kind of it. That's all we got here. I mentioned Apple already. They had their iPhone launch here today. Lots of cool things if you're into the Apple stuff. I don't follow it much. I have an iPad just because my daughter bought me one, but I don't have an iPhone or watch or thing. I don't have any of that, so I don't know much else to say there. I didn't track the stats on all that. Chevron, So a lot of activist investors are now starting to go after these oil producers and saying, we need to increase production. Right? So they're trying to take stakes in the company and then say, quit giving money back to shareholders, get out there and make more oil, make more money. And I think it's all politics in this case. I'm sure they would like to, but it's all politics. Target. The CEO signed his deal to stay for the next 3 years there. That was basically the excitement there. People like the Target CEO. He's done a great job there. Brian something. Obviously, sales, great, competing with Costco and things like that. So they've done really well, especially online, their movement to the online space. United Airlines in the news there. They basically just came out and said, hey, for Q3, we had given you a number. And Wall Street basically agreed on this number. United said, we're going to be about 12% higher than that. So that's good news. Stock's higher on the day, 5.5%. That's the kind of thing that will lift a stock, right? When you impress Wall Street like that. Kraft Heinz said something similar, just not as much, not as big of a beat there. So without being geeky with you. And then Rubbermaid, or now you call them Newell Brands, right? This is just Rubbermaid. Big sell-off, most recent stock to hit new 52-week lows. And they have said in the retail space of what they do, you know what they do, Rubbermaid, right? In the retail space of what they do, weaker sales. I think that was mentioned over a dozen times in their comments there. So they're trying to drive the point home for people. Hey, weaker sales, weaker sales, weaker sales. So not good for them. Tomorrow, you got DocuSign reporting earnings. I don't know what to expect out of them. They do beat more times than they miss, but the stock is an exact coin flip in terms of performance. You got National Beverage, which is pulled back. I don't know. Some people like this sort of thing. I know it was a hot stock there for a while. They report earnings as well. I got to hear from RH, or Restoration Hardware. They report earnings. This is a big miss for, it wasn't Warren Buffett that bought it. It was one of his people that work for him, but that's a big losing position there. And Smith Brands. If you like guns, Smith & Wesson. They report. Do they report tomorrow? They do report tomorrow. They usually don't make the news, but that'll be tomorrow after hours. Okay, also, you got Jerome Powell speaking tomorrow. That's a market-moving event there. Everybody will be focused on what he says. Then you have just two other Fed members speaking throughout the day. Natural gas numbers come out. If you're interested in what's going on geopolitically, natural gas, a good ETF to use is UNG. If you want to follow that, no doubt that'll be volatile tomorrow as those numbers come out. And the rest of the oil inventory numbers come out because Monday was a holiday. So anytime Monday is a holiday, they push it forward a day. So there you go. I'll take your questions if you have any questions. Otherwise, there's not too much else to say there. Yeah, I think I've covered everything that I want to cover anyways. Let's see what you got. DAD finally made it to a live YouTube. Well, welcome. Congratulations for making it. Whose birthday is it? Whose birthday is it there? Let's see whose birthday is it. Is it Joe's birthday? Let's see. You like the dividends on your Nucor? Yeah, popular stock lately. So for a while there, it was actually holding up better than the market. Year to date, I believe it still is, but yeah. And you get your 50 cents a quarter, right? 50 cents? Yeah, 50 cents. Very nice there. I appreciate that following for today. Again, okay, the market was up. Yay, right? It doesn't tell you a whole lot. So don't let one day make you make a huge decision there, right? Hold out. Let's just see what happens. Let it prove itself to be going against the grain. Tomorrow expected to be kind of choppy. The next day after that. If those 2 days are nice and strong, there's your indication that people aren't willing to wait. They do want to buy this higher low. And who cares if you buy a 0.5% higher than where you're at there. Hey, man, happy birthday to you. I hope you got some big plans over there. Do you do like poker night on your birthday? Is that like a thing? Like your friends expect you to deal, or do they deal for you? You know what I mean? Come on. All right, guys, enjoy the rest of your day or evening. We'll see you tomorrow for Wine and Wealth. Our focus on the geeky side of retirement will be carrying forward tomorrow. And Eric's got a couple good things too going into the rest of the month. So we'll see you then. Enjoy. Thanks for watching and subscribing and all that good stuff. Adios.